very simple but very important topic, which is called credit demand. I like this topic mainly because majority of my colleagues in credit management really skip it, and but at the same time, it has quite a potential to improve credit performance despite its simplicity. Quite recently, we had a discussion about it with Michael Dennis, who will join us on the next event dedicated to credit insurance. You will see an announcement later on. And interestingly, his opinion about credit demand is simply not to estimate it at all and leave it to our sales colleagues. Well, it is also a position. I don't say something is good or bad, or I don't even try to add any assessment about the topic of credit demand and about the practices of other credit managers. I continue to share with the audience, with every one of you, the concept of holistic credit management, which I developed so far and continue to develop and continue to share with every one of you. My experience shown that this approach to credit management is quite resultive. And piece by piece, I share with audience in masterclasses, different items of this approach, and credit demand is one of them. So, first of all, let me define what is credit demand. As you may know, but before I start that, I just explain how we will work today. This will be a 1 hour, maybe a little bit more masterclass in which we got only 3 rules. Please interrupt me any single moment of time if what I explain is unclear. Please don't hesitate to criticize me if you don't agree with this concept or its applicability to credit management, or whatever doubt you have, please share with us. And please ask questions. The only thing I actually want to get from this masterclass is to get your questions to see whether or not it works, whether or not it's helpful, or if there is a need in specific application of this concept, please ask me. Type your questions in the chat. In the end, we will have a Q&A session where you can ask your questions as well. So whatever way you ask, whatever way you interrupt, please do that. Okay, so let's start. The definition of credit demand is quite simple. It's an amount of credit which is needed for a transaction to happen. I believe it would be difficult to dispute the simple fact that every single business transaction contains a specific amount, a certain amount of credit. I can prove it quite easily. Simply say that there is an element of credit in any commercial transaction. An element of credit is defined quite simple. It's a certain economic value trusted by one party to another one for a certain time. In our course, DeepCM, sometimes we try to find a transaction which doesn't include this, and majority of people fail. I didn't find such a transaction which would not contain this. If you will find, please let me know. I will be happy to hear that. So the concept will be broken completely. I will start working on another one. And since every transaction contains credit, we have to, or we need to define it, because for us, when we grant credit to our counterparts, we need to know how much credit is needed for a transaction to happen. this does not necessarily mean that we will grant all these credits, or this does not mean that we necessarily give credit, but understanding how much credit is needed is quite important. It might look very basic at first sight. For instance, if I try to sell my watch at whatever, 100 euros to somebody of you who are ready to pay for it, the credit demand of this transaction will be 100 euros, because we do one-time transaction. Or if we sell our house, the amount of credit needed for the transaction, even though the term between, signing documents and giving money, or, sending a payment, will be quite short. There will be still credit in it, and the amount will be cost of the house, cost of property. Obviously, when we go for bank, if our purchaser, when we sell a house, supposed to take a loan from the bank, things become a little bit more complicated, because bank will imply certain terms on the customer. And for instance, our purchaser would have only 20% of cash, and then another 80% will be given as a credit, as a loan to them, because bank might not be happy to provide a loan, a loan as a full amount of purchase. This will be only 80% or 60% or 50%, certain percent. But things become even more complicated when we sell 1,000 of such watches, like my ones. Or maybe we will be selling 100 houses, or we work with a customer who plans to work with us for years, and they purchase from us certain amount of goods every month on certain credit terms, let's say 30%. Recently, in preparation to today's masterclass, I started a very small poll, very basic one. So the task is, a customer purchases from us goods for 1,000, whatever currencies, let's put euros or maybe British pounds, whatever, 1,000. And the credit term is 30 days. And very basic. Let's do this poll today, by the way. Let's try to use it. Can you please simply put your answer in the chat? Again, the problem is 1,000 worth of purchase per month, customer has 30 days credit term. What would be a credit demand of this customer? There are three possible answers: more than 1,000, equal to 1,000, and less than 1,000. So let me have your answers. Yeah, think a bit. 2,000. So it is more than 1,000, Phil. Thank you. More than 1,000. More than 1,000. Okay. So thank you very much for your answers. I see that majority of you think that this will be surely more than 1,000. And this is like, starting point, because in the poll we had on our page on LinkedIn, about 60% of people answered more than 1,000, and actually we're speaking about mainly. I try to break the understanding of those who believe that this will be equal to 1,000 and less than 1,000, because another poll we did, another kind of research, shown that majority of people use DSO to calculate credit demand. And this makes, personally, this makes me a bit concerned, because if we take, I mean, how can we calculate this? We simply calculate how much credit is needed, knowing that customer buys from us for 1,000 per month. What we do, we use DSO formula. We divide it by 30, I mean, divided by 365 and multiply by 30, and we're supposed to receive more or less the same 1,000. But the problem of this, that we got average receivables which we expect to have on future purchases. And the problem with that is that, I mean, the future receivables never equal to never equal to average. And this is the biggest problem, because if we simply estimate credit demand as a as average, we simply disregard all the cases when we have receivables above it. And if we simply put the credit limit on the level of credit demand, we open the door to all the potential problems, which I tried to explain in the post preparatories. So, meaning that a truck coming to our premises, to our warehouse, to purchase to get some goods from us, and then warehouse operator tried to make an order to deliver goods to a customer, and they find that the credit limit is fully exhausted. And we start, long-term negotiation. Sometimes this takes half an hour, sometimes this takes three hours. All this time, the truck driver is going back and forth and says all the nice words about the company, the customer, and everybody. But we can avoid this everything by simply estimating credit demand in a proper way. Just to be precise, when we use credit demand, so let me stop this video and open my presentation. Just a second. So when we use credit demand, the credit demand is quite easily used when we take a credit decision where we compare credit worthiness and credit demand, and then we decide what to do with difference. And the difference is actually, and then somewhere in this difference, we put credit limit, which is our decision. So in simple words, we take an understanding how much credit is needed for the transaction to be completed in full, and then we compare it with the amount of money which could be safely trusted to a customer without any additional security, which is credit worthiness. And then we understand how much risk we have to take, or we might need to take, and we decide how much credit we will give to a customer. So how much credit is needed, how much credit is safe, and then we decide how much credit we will give, which is credit limit. This is what is put in our methodology, which we call holistic credit management. Both these things contain their own factors affecting them. Credit worthiness will be subject of our coming webinars, coming masterclass. And then today we speak about credit demand. But decision, what we take, you can see it here, comparing these two things. We try to define our optimal credit terms, which actually help us to establish the, let's call it, undisrupted supply. So we make sure that customer buys, actually orders products from us, pays for them on time, and order again. And this does not require any additional efforts for either person within the company. It just works. Today we will consider what are the factors affecting this this term or this parameter, which is called credit demand. They're listed here. We got volume, we got price, we got logistics, we got schedule, we got a couple of etc. So let us consider them. Just a second. And one of the most important component of credit demand is actually credit term. We already did a masterclass, the masterclass dedicated to credit term. I will send to every one of you a link to this masterclass, so where you can see the approaches we take to define the optimal credit term. And those of you who will register will receive also the Excel tool, which helps to define an optimal credit term. So the main important factor which is affecting the credit demand is here. It is credit term. It is quite intuitive because you know by your practice and you know by your experience that the longer the credit term, the bigger, the more receivables we have with the customers for the same volume of sales. So if we sell for 1,000 every month with 30 days credit term, we're supposed to have about 1,000 plus something. If we got 90 days credit term, this is for sure will go above 3,000 credit demand. This might not happen in the first month immediately, but over the 3 months, this will rise to 3,000. So we should not expect anything less than 3,000. Another major parameter affecting credit demand will be our turnover with the customer, which normally dependent on 2 main parameters represented by volume and by price. So the more we sell, the more receivables we need to continue to sell to support our sales. And if, for instance, with the same volume, we got change of price, if price is changing, if price is increasing, the credit demand of our transaction will be higher. Why this everything is important? Because too often companies continue to work and see their credit limits as they are, and they simply disregard the change of volume and prices which are coming, and then they face this credit limit issue, which normally bring a lot of unnecessary efforts to then to review these credit lines in firefighting mode, which I personally don't like. I mean, if you like it, I don't mind, but personally, I'd prefer to be prepared. To share with you kind of very, very little thing, an experience I received once in my corporate career. I received a call from my colleague in sales. He said, Andriy, can you help us? We got an order of our customer on hold. Said, look, if you call me when this order is already on hold, it's already a bit overdue. We need to speak about it before the order will go on hold. before the order goes on hold, before we got, trucks coming, or, all these logistics become an issue, because main idea of credit management is to support sales, and sales supposed to go just themselves. Customer pay, purchase, and we supposed to create conditions under which this everything is possible. This is the most cheap and most effective credit management. Make customers purchase and pay. As Walking Bear or Abe Sanchez, Walking Bear, used to say that he had great saying, like, keep them buying and keep them paying. This is in simple terms, this means the whole job of a credit manager. So what we need to include into this concept, this formula, which you see now on slide, is quite simple, and but it is not enough. It is what is called DSO concept. If we simply calculate, we will have average receivables based on the sales we have. And before we continue, I just need to say that credit demand. Why our today's masterclass is called estimation of credit demand. We may say calculation of credit demand or even assessment. But as we speak about future, we never know for sure what's gonna happen. And everyone, to my personal experience, everyone who says they know future, at least they lie. In worst case, they manipulate. So here we say that credit demand or future receivables or receivables forecast is normally based on the sales forecast. Therefore, our credit estimate, our estimate of credit demand will always be as good as the sales forecast is. So accuracy is highly dependent on the accuracy and the quality of the sales forecast. We can overcome every inaccuracy by quicker update, constant updating of the credit demand, and this is what I recommend to do. But we will see that later. Again, we got forecast of turnover, normally based on volume and price. We got our credit term, and if we divide it by 365 and multiply by term, we will have average. What's the problem with average? The problem with average, if we put it as a credit limit, would be exactly as you see on the slide. Receivables are going up and down, but we continue to treat them as average. Therefore, if we say these are months, here, here, and here, and here, we simply disregard moments where the credit demand is significantly higher than average. If we are in a position where we can afford what is called extremely conservative credit policy, this is not an issue. Not an issue at all, because if there is not enough credit limit, we say customers will be happy to pay us a bit in advance or send, pay, all the excess of above the credit line, and this gonna be okay. But such a luxury, affordable, to my personal estimate, is affordable for about 20–25% of companies. 75% of companies have to compete. And if they don't estimate, if they simply disregard all these things, we can say this is not, this might be lost sales. Therefore, lost profits, therefore, additional expenses or expenses which won't be covered. And this also creates the room for the competitors. Because very often, if we don't sell, our competitors will. And it is quite difficult, to those of you who work in competitive environment, who has to compete. Underselling is unaffordable luxury. Therefore, we need to know how much credit we need to give always. And if we really underestimate it, we might be cutting our own sales. We might be wasting our investments of our company in marketing, in sales. Being now freelancer, I know quite well how much it takes to sell, what it takes to sell, and trust me, this is difficult. And if we undersell due to our own mistake, this is something which we need to correct. Technically speaking, all this concept of credit demand, once I started to think about this concept after quite long discussion with the sales director of a company I used to work for, and he said, how can we be sure that what we provide to our customer is adequate to our sales? So do we provide as much credit as it is necessary to sell as much as we can? Because this is actually our business. Now, when we say cash is king, we're supposed to remember that cash is coming from sales. Majority of cash flow is coming from money paid to us by our customers. And if we cut the sales ourselves, this is supposed to be either hardly justified or supposed to be treated as at least as a mistake. So how can we avoid, or how can we this average issue? How can we make our estimation of credit demand a little bit more precise? First of all, we need to we need to take into account what is called impact of shipment schedule. You see here, let's put here option 1. Classical example of what is called load after load. So we say that here we got 0 receivables, then we ship a lot of goods. These receivables stay like this, then we pay, then customer pays, and we ship to them another load. In this case, let's say this will be our 1,000. Quite simple, but very often, and you know that without me, for that you don't need to listen to Andriy Sichka even 15 minutes. You know the situations where we have to ship to a customer before we receive a payment. And this is exactly what is shown here on the option 2. Here due to logistics, due to scheduling, due to, there might be 1,000 reasons for that. And if we simply ship to a customer, let's say only once per month, we can always face a situation where we have to ship before we receive payment from a customer. Customer is not good or bad. We simply should take into account that in this case, the credit demand of a transaction will be already 2,000. By the way, Phil, I've noticed your answer of 2,000. So I believe this is exactly the scenario you had in mind. If we ship to a customer once per month, we're supposed to double the amount. And this is what is, we also may call it shipment payment overlap, where, one shipment is going above. And if we ship to a customer once a week, we're supposed to add to what we calculated on average. Let's assume that we don't have better numbers than monthly forecast, or we simply got average. But if we know that we ship to a customer once a month, it will be, to stay on a safe side, when we estimate credit demand, we simply add a weekly amount of sales on top of usual average. This will be already more prudent. This will be already more prudent than simply calculate average. So keep in mind overlap. In very simple terms, it looks like this. And another way to overcome this average receivables, you can see here. This is one of the most precise approach to estimate credit demand. However, this would require quite precise shipment schedule. This methodology, I know about 5 different names of this. I'd prefer to use the definition from Chartered Institute of Credit Management Accounting Handbook. There it is called continuous balance, where we have date, where we have document or description, we got delivery, or we got shipment, we got payment, and we got balance. So we may list here all the shipping documents, and here we use an example of 14 days credit term. What we know is that shipment of 100 here supposed to become a payment of 100 in 14 days. So as here we say that if we ship on November 5th, we're supposed to receive cash on November 19th. And obviously, if we know that our customers pay with delay, we may add a couple of days for that. If we plan in cash, for instance, for our treasury colleagues, or we may keep it as precise as usual credit term, simply assuming that we are not the company who finances our customers overdue. Whatever we apply here, we will simply see that our balance will be changing nearly every day, and we can always find maximum. Here it will be 270 maximum outstanding, which would represent the maximum amount of credit needed for transaction to be happen, so to ensure the maximum level of sales, which is technically credit demand. This is quite easy to, as you may see, it is quite easy to use this methodology in Excel. And very often, I will speak about this a little bit later. We may also use it we can implement it in ERP system if you wish. I will explain this later. We will have time. So having such a focus, we can add to it. You see here. This is simplified chart for the credit decision making. So if we know that our receivables are changing like this, we may put current credit limit. We obviously define, which is 270. This will be our credit demand, so we know it is it is as high as this, and we can put customer credit worthiness, so we can see how much risk we will have to take if we put credit limit on the level of credit demand, or if we put credit limit on the level of credit worthiness, how much sales we could jeopardize with this. So we got kind of clarity about the future of receivables, and then we decide what to do with this. By contrast with the situation I've explained when we got all these credit limit issues, the high importance of the credit demand concept and its estimation is that we, in terms of time, we are already here when we estimate it, and we looking at whatever our angle of view will be on this situation, on this situation, on this situation, and on all of that, is that we do have time to think and to find a solution. Sometimes this solution might presume, postponement of the shipment. Sometimes this solution will be calling customer and ask them to send earlier payment. Sometimes this solution might include provision of security. Sometimes asking for additional security or providing an exception. Whatever option we would choose, we have time to think about it. And we got, kind of stable situation where we have time, and because we consider issue which might happen in the future. We foresee it. Therefore, we work in preventive way. In this holistic credit management approach, we say that there are 4 main qualities, 4 main properties of effective credit function, and one of the most important of them is that effective credit function is always preventing. So when we foresee issues and try to deal with them before they happen, so we prevent them. This way, this approach to credit management will be always the most effective, just because every preventive measure will be cheaper. We deal with issues which didn't happen yet, so we don't lose money. The problem with issue when we try to solve it is because when it already happened, every second we spend to find solution, we already lose money. When we are preventive, we look into the future. It is we wouldn't know the future for sure, but we can estimate it, and we can foresee issues, and knowing about them, we might find a solution. And as we have time, we can always call our sales colleagues or logistic colleagues or other colleagues, whoever, call customer and say, you see, here there will be an excess of credit limit. What can we do about it? What are the options available? And we can choose best option, because when we are in rush, when we what is called in chess, it is called Zeitnot. When we are in rush, it's quite low probability to have good solution for the issue, because we don't have time, we don't have resources, and so on and so forth. Therefore, estimation of credit demand is as good as timely it is, and timeliness of credit demand estimation is always before. In terms of practice, I used to say to my sales colleagues, please, each time you have changes to your sales focus, I don't try to go to your territory and try to focus sales instead of you. But if you got new focus to sales, please share with us, so we check whether or not our current credit limit, our current setup is still okay with these sales. Or otherwise, we might need to do something to review. And we might need to think what could be done in order to support our sales, especially if they are growing. If they are falling down, the same story, so we are prepared. And one more important thing, so let me show you another slide which I use. So this is what we call demand. See, here you can see, so in practical terms, how it is done. We simply we simply put volume, we simply put price, and we find sales. Here, for the simplicity, we got 50,000 per month. And based on 30 days credit term and based on 50 days credit term, when we estimate, when we define optimal credit term, we never got specific number. We got what is called corridor or range between 30 days and 50 days, and then we align with customer. But for the simplicity, you can see we got 30 days and 50 days, the range of optimal credit terms, and we estimated demand. And you see here, because we assumed there is a weekly shipment, we simply added 12,500 to the credit demand. Therefore, we know that so we know that there might be an overlap of 1 week sales. Therefore, we estimated credit demand as 62,500, could be 63,000. There is no need to be, literally, very precise in that. And with 50 days credit term, we simply say that this is very close to 60 days because there will be still this weekly overlap. So we simply put that with 50 days credit term, it will be, the good estimate will be 100,000. And this is the way we estimate it. And by the way, as you see, usually we use the same approach as shipment and payment. And using this table or any one you will build yourself, you may see that we always estimate mainly we are not estimating credit demand, we are estimating payments. So you can see with the 30 days payment term, we're supposed to receive about 50,000 every month starting from the 2nd. And with the 50 days credit term, we're supposed to receive, first month we won't receive anything. On second month we will receive about 1250 for 12,500, and then this will be again 500,000. And this cash inflow forecast, or simply cash forecast, is quite useful information for our colleagues in Treasury who really appreciate it. And if we have changes, and if we can estimate and we update our credit demand forecast, but if we also forecast cash as a part of it, we can always use it to share with our Treasury colleagues, share with them, and trust me, they usually appreciate it, because this is our, let's say, cooperation with our colleagues in other departments, not only in sales. Well, as you may see, all this concept of credit demand is very far from being rocket science. It is very far from being complicated or difficult. It just requires a bit of discipline, but a bit of discipline, very basic math, a little bit of thinking. But when you use it disciplinedly, you remove significant number of issues usual credit department normally has. So this reduces, first of all, this reduces a number of the sales orders on hold. It's a quite difficult routine thing, because I know that majority of orders on hold went on hold due to internal mistake, or significant number of them. Then secondly, this improves our cooperation with sales, because they see that we take care of them, we take care of sales, and they're happy to cooperate. They're happy to share with us their data. And in the end of the day, cooperation with sales, I mean, is very difficult to overestimate. The more time we spend with our sales colleagues, the better results we have in terms of credit management. And furthermore, with this estimate of the credit demand, we got updated and quite fresh cash inflow focused, which could be treated as a good gift to our treasury colleagues. And in very, simplifying this with a motto, we say that credit management is a team or is a function which becomes successful by contributing to the success of others. And basic, very simple concept of credit demand could be of very good assistance to succeed in this way. Well, this is everything I wanted to share in terms of our presentation and in terms of the concept. And if you have questions, I'm happy to answer. Well, I
haven't a question. I just want to say that was very good. Explain that.
Thank you very much, Phil. Is it okay? Let me ask you now a question. I don't know if I believe you do kind of calculations in your practice. Kind of this, I mean, more or less the same kind of calculations in your practice. Do you use it? Because I know you're quite long in credit management, and may I ask if you use it and how does it really help in your credit management operations?
Yes. I mean, what we would do is assess a customer. What is the short term? We only work on short terms, probably 3 to 4 months, maybe 6 months at the longest.
Okay.
To determine what demand is over that period. And sometimes it won't divide equally into months. So we would just do a simple calculation of, how much each month will this go through, what will be the exposure underneath, and what is the limit we're comfortable with. So it may be that we go to the customer and say, on this particular month, we would need something on account, or we might be able to accommodate it as a temporary limit, and provided you pay on time, then, we go forwards into the next months. And if you don't pay on time, well, we won't be going forwards with you. Yeah. So we try and find a solution.
Overdue, yes.
Yeah, we try and find a solution to it all.
Yeah, and also maybe another thing to share, more or less the same concept we may use when we focused receivables. This is something I actually overlooked to share with you. When we also work, and based on my experience, Alessandro, Alejandro, I'm sorry, but it is not related to credit demand, which explanation was very clear, but more about how to calculate the credit worthiness, maybe a subject to another masterclass. Alejandro, I could not promise this will be next masterclass, but this year, for sure, we will have a masterclass of credit worthiness, on credit worthiness. I will thank you very much for your question. Anyway, I will share with everybody, because we did a kind of webinar. We did a webinar. I think it was in 2020 or 2021. I will double check. Which was called Credit Worthiness Check and Trust. Major part of the concept is already there, but we will have a masterclass dedicated to credit worthiness as well this year, because too many things happen and we need to update this concept. continuing with the credit demand, one more application. I simply didn't have slide for it, but we also know that FP&A team or accounting team of a company is also a stakeholder of a credit function. So when we have annual forecast of sales, we normally got a good chance to provide our FP&A or finance planning and analysis or accounting or planning team with precise, or let's say much more precise than they are able to do themselves, forecast of accounts receivable for the whole company. The approach is technically the same. We simply consider our accounts receivable as one customer, and we use the same calculation. Again, you may apply much more precise calculations, and you may use main approaches, but simple things that we need to take into account volume, we need to take into account sales, we need to take into account schedule of shipments. And with the longer terms, like with the 30 days terms, it's quite easy, I mean, especially if they're like 30, 60 and so on, because equal to months. It become more complicated when we got terms shorter than 30 days. But still, we may use weeks, we may use other approaches to do that. And I promised to tell you the application to the ERP. Well, obviously, in one of my teams, it was not done completely by me. I was simply sharing the concept of credit demand and how to calculate and how important it is. And in one of my teams, I had a very talented credit manager who used to do a lot of different automation projects for the company, for us. And we, at certain moment of time, having all these issues with sales orders and sales orders on hold, and it's quite a big workload. And we just found that our colleagues in customer service and logistics department they actually enter into the system. They enter sales orders for about a month, or sometimes even longer than 1 month, for 2 months, and this is already become actually a shipment schedule. So what we did, it was quite simple. We found a way to reflect these coming receivables in SAP, and it was done actually without any job of programmers or redevelopment something. It was found nearly within the standard functionality of the ERP, if I'm not mistaken, or with quite minimum application of programming work. But in terms of help, so how did it help us? It was quite enormous, because after the first day of implementation, our colleagues from our logistics colleagues started to come back to us and say, thank you very much. Now, when we enter the sales order, we know that this order will exceed credit limit, let's say in 2 months. So we can already inform a customer that, their credit limit with this sales order might be exceeded. So we can find solution. They call us immediately, and we find solution before this issue could even happen. So we don't provide this issue with a chance to happen. We resolve it before it might even become true. This is one of the applications. Again, I could not tell you how specifically to do it in a specific ERP system, but I can confirm with the with the practical, with empirical experience that it really works. And you may see, you already seen, it's very basic math. You don't need to apply rocket science, artificial intelligence, math, everything, integrals and whatever else is. You simply do basic arithmetical calculations. And this saves a lot of time and, help to become quite quiet and effective credit function. Your explanation was very clear. It reinforces how close the sales and credit department have to be in line with sales focused and targets. Absolutely. And the last sheet you showed certainly helps others to have a notion about the receivables exposure. Yes. Well, actually, when you do a business review, you may put slides like this, and I will be sharing in further master classes, things we can do. So you put on slide the situation with the customer, and you go to your sales colleague and to your management for business review, and you take decision together. Yana, totally agree with the quote that credit department estimate is as good as a sales focus. I think this is the issue I struggle with mostly. I am always, but thanks for inspiring class anyway. Yana, I believe you're too good to me. It's a very basic concept, but once to share with you a joke. Once when I came to my sales colleagues, in one of the companies, I gave them a kind of quote that focused could not be precise by definition. And they simply love that concept because, we look into the future. Who knows the future? No one can know the future. It is, every focused is by definition is imprecise, but we simply do our best estimate and work with it. If you, to tell you truth and to invite you for the coming masterclass, when we speak about creditworthiness, it is also an estimate, it is also a focus, and it is never precise. But the difference between not estimating and estimating, or let's say estimating imprecisely, it's just like, imagine you are driving in a fog. Yeah, you got very limited visibility, but you still got something. At least you are able to see something, just like maybe 3 meters in front of your car, maybe 5 meters, maybe 10. You can move, but compare it with the, being completely blind, just closing your eyes when you see nothing at all. And you will understand that, this imprecise focus is already something better than just, close your eyes and, run as a deer in the firing wood and being led by the destiny. Sorry for that joke, but that's very often companies do like this. Karin, I guess that the credit approach has to be more focused on creditworthiness. Many times the creditworthiness is higher than the sales focused. Absolutely. Well, if in your practice you got, Phil, thank you very much for coming. It was really an honor to have you here today. Thank you very much for joining us. Shaking your hand and hope to see you on coming events. Karen, I continue with you. We need to, honestly speaking, to answer your question, we need to calculate both. We need to be very clear about creditworthiness, and we need to be clear about credit demand. And in the cases where, or in these cases where we got credit demand higher than the creditworthiness, the decision is just as obvious. You're absolutely correct. We simply increase credit limit to the creditworthiness, or to the more precise to credit demand. Let me see if we got. I need to get to another call. Nikki, thank you very much for, sorry, Jana, thank you very much for coming, and Alejandro. Well, ladies and gentlemen, thank you very much for coming. Last joke, maybe for today. Once we had an issue, we had a request, and the request for credit increase from our team working with the customer on Far East, and they came, and it was quite drastic because they sent a request to increase credit line from 5 million to 25 million. And well, my boss bring it to me and said, Andriy, it looks quite drastic. They simply said, well, just give me about a couple of hours to calculate. Fortunately, this was publicly listed company, and we calculated credit worthiness, so we estimated credit worthiness, and we found that it was kind of very close to $1 billion. Came back to my boss and said, look, I got only one question. Why they increase credit line only to 25 million? Why not 250 million? Or let's say 500 million, so we have more sales with them. And yes, understanding of our counterparts' credit worthiness is also an important subject, and we will take care of, and we will share the methodology for credit worthiness assessment later on this year. I promise this. It's already on the plan. Karin, thank you very much for coming. Thank you very much for your attention and for your appreciation. And I look forward to seeing you on the coming events. Ladies and gentlemen, I still got a bit of time. If you have questions, I would be happy to answer them. Otherwise, you may ask your questions to my email directly. I believe you will have my contacts. Or you may ask them in comments, or find us and follow us on social media, where we share the content dedicated to credit management. And I do wish every one of you higher sales, low losses, or as people say, might say in French, bon crédit. Stay tuned. We will see each other on the next event. Thank you very much again. Bye-bye.